There we go. Got it plugged in now. Test. Test. There we go. Got it plugged in now. How's the audio? Is there any buzz? Test. Test. There we go. Got it plugged in now. How's the audio? Is there any buzz? Test. Test. There we go. Got it plugged in now. How's the audio? Is there any buzz? Test. Test. There we go. Got it plugged in now. How's the audio? Is there any buzz? Let me just get rid of this. Oh no. Shut down the wrong window. Thanks, Douglas. I appreciate that. Okay. So I kind of had, I might actually switch my headset since this one doesn't have a good working left ear. I gotta use my Bush League headset. There we go. Okay. Just wondering whether I should give people a little bit of time to show up. I was kind of expecting, I don't know, like 10 to 20 people. So yeah, in this exam session, I wanted to kind of go over what you might be looking at on your Accounting 100 or AFAA 100 exam if you're from Ryerson. If you're tuning in from anywhere else, then this covers the exact same content as any intro level financial accounting course. And I just wanted to kind of like walk through some of the elementary steps, you know, anything that you're not getting. I do have some slides, but let me hear from you. What do you guys want to cover? I do have a long problem that we can work through. That goes through kind of like the accounting cycle, adjusting entries, financial statements, so forth. Kind of like the accounting cycle, adjusting entries, financial statements, so forth. Okay, so let me just quickly make like a little list. Just shout out in chat anything that you want to cover. Could be journal entries, could be merchandise inventory, could be like accounting cycle, financial statements, could be you don't understand the revenue recognition, gap principle, matching principle, or if you just want me to kind of go through my slides and then maybe you'll get some ideas, I can do that as well. we got a PPE. Personal protective equipment. Every single time I've seen that on the news, I've been thinking property, plant, and equipment rather than PPE as the healthcare workers have been treating it as. Okay, so we have PPE. It's just not the PPE in the news, but property, plant, and equipment. What else? Throw it out. Revenue recognition. Okay. Also, this is my first YouTube live session, so I'm still getting used to the controls, so I apologize in advance if I'm a little bit slow with, getting to different functions. I'm going to do just a quick kind of run through of the accounting cycle to begin with, just to summarize everything that you've learned and make sure that all your fundamentals are there before we move on to anything else. So let's go ahead and, well, the first part of our accounting cycle, I actually should have a little slide here, is that we've got transaction analysis. And transaction analysis is actually just our brainstorming stage of identifying events, economic events, or transactions between different parties, and trying to see what's going on. Like, for instance, did we sell inventory to a customer? That would be a transaction. Did we do we need to amortize an intangible asset? That's an economic event because we're not actually, we're not buying or selling anything between another party. We're just, this is a change in the value of an asset account. So this is all part of the transaction analysis stage. You just want to kind of get your bearings. Afterwards, you're going to be moving to debits and credits. Or actually, I'll have, I should have my journal entries up here. Let's move them up here. Okay, perfect. Yes, so every economic event or transaction is going to be recorded as a journal entry. So, I should have my tablet pen here. There it is. And we have, an example, like I just said, an economic event is going to be a change to the assets, liabilities, or equity. And we're going to, one instance of this is like recording depreciation on equipment. Transactions occur between two or more entities. That's also another type of journal entry we will do. And let me just open Photoshop, since, everyone's more used to me kind of like drawing, although I think my drivers might be a little bit messed up, so hopefully I can write semi-legibly. Okay, so right now. We're going over the, oh god, it's a lot more difficult to write than I thought it would be. Oof, it's pretty ugly. Okay, but so we went over transaction analysis, which is kind of our brainstorming step. And then we move on to journal entries. And journal entries are a way for us to kind of tell our story about what's going on within the company for the year, because everything that is reported in our journal are going to be entries in chronological order. So we'll be looking at, from the beginning to the end of the year, and then we will start a new journal for the next year. And the journal revolves around using debit and credit entries. So, your double entry accounting. So we'll have, every journal entry requires one debit and one credit. And that way, when we compile and summarize all these accounts and have a trial balance, we'll be sure to have a balanced statement between debits and credits. So journal entries, they're the way for us to record what's going on in a transaction or economic event. Remember that the left side are your assets, which are always going to be debits, and your liability equity side, you'll use credits to increase them. So the normal balance of the left side is debit, and the normal balance of the right side are credits. So that means that if you want to increase your asset accounts, you're going to debit it. If you want to decrease it, you're going to credit it. For liabilities and equity, if you want to increase it, use credit. If you want to decrease it, use a debit. So debits are equal to credits. Now, the accounting equation, which is your assets are equal to liabilities plus equity, you can think of it like assets are future economic benefits that are going to be controlled by the company. So note that it's controlled. You don't have to technically own them, because some may be like leases that you have, and those are still considered capital assets at times. But in a very simple way of looking at it, let's look at some of our assets like cash. So cash, for instance, provides a future economic benefit by being able to reinvest in our business. Use it to create some return on our capital. Receivables, on the other hand, will normally be able to collect those over time and convert those into cash. Property, plant, and equipment, another type of asset. We're going to derive future cash flows, which are going to be used in our operations. And then we have our liabilities, our future economic sacrifices, kind of like things like what we owe. So accounts payable, salaries payable. You'll notice that a lot of these liabilities are payables. And then we have also unearned revenue, sometimes called deferred revenue. There's many terms in accounting which are kind of synonymous, which is fairly annoying. And if you also major in finance, it's going to be fun going back and forth between things like accounting, or like income before taxes, and EBIT, and EBITDA, and income from operations. So you're constantly trying to reconcile all these terms. And then, of course, equity. Equity is your residual interest. So your residual interest are going to be your net assets that are available to owners. And if you think about it, like the way I always like to think about it is like one big pie. God, this tablet is really bad. I do apologize, and I will get a better one next time. You know what? I'm gonna use shapes because that's much easier. Let's see. What's a pie color? We'll use yellow or something. So whenever I want to think about assets, liabilities, and equity, I try to think about this. You know, half of this is going to be you know, assets. This is half of your pie. I really wish my tablet was working better than this. This is a pretty ugly looking pie. And your liabilities are going to be the amount of debts and things that you owe. And then, of course, you'll have also whatever is left over. So after you pay all of your debts, that's going to be your net assets. So, you know, I don't think that was a perfect way of conveying that concept because my tablet is so horrible. So I'm going to just stick to PowerPoint from now on. And also do questions in Excel. That's probably a lot better. So yeah, equity at a basic like accounting 100 level, sometimes you might not even have common shares or preferred shares. Sometimes it'll just be called owner's equity. And that's also the same thing because that's the amount of equity that's in the firm. So for instance, sometimes it's also called just capital. And in large corporations, you'll have common shares. And retained earnings is your net income that is accumulated over time, less any dividends, and then also adding whatever retained earnings balance you had at the beginning, plus retained earning balance. So now I just quickly wanted to go over, one second. All right, just had a little bit of noise in the background. So yeah, just let's kind of get comfortable with normal balances. I want to see where everyone is at. So, you know, shout out the answers if you know these. Let's just do them quickly. Normal balance of cash. Throw it in chat. Correct, debit, yes. And our classification, so normal balance of cash is going to be debit, and then we'll have asset as the accounting element. And if you don't remember, our accounting elements are assets, liabilities, equity, revenues, expenses. And then you can sometimes also say like gains and losses, but let's just keep it to the 5 for now. Salaries expense. Normal balance. What is it? You will get a high five like this person did. Or a clapping, I should say. Salary is expense, credit. Is it? So salary is expense is going to be a debit because if you think about it, let's go back to the accounting equation where assets have a normal balance of debit and liabilities and equity have a normal balance of credit. So let's think about how equity is, what are all the subdivisions of equity? Let's add a little slide here. Okay, so equity. Equity is made up of what? Common shares or capital plus retained earnings, right? Now, what is retained earnings made out of? Revenues less expenses less any dividends. So expenses, if expenses are increasing, well, I guess the way of looking at it as this, equity has a normal balance of a credit, since we know that the right side is equal to credits. Expenses, if we have more expenses, that's going to reduce our net income, and our net income being reduced is going to have a negative effect on our retained earnings, and a negative effect on our retained earnings is going to have a negative effect on equity. So when we have an expense's normal balance is going to be a debit because it has a negative effect on the equity account. So let's go ahead here. Normal balance is a debit, and it's an expense entry, just like Jeff he said. Let's give you one of these. Accounts receivable. Where are we going after this? Accounts receivable. Who wants some sweet karma emojis? I should have like a little Jeopardy song in the background. So accounts receivable, it's going to have a normal balance of a debit because it's an asset, and the classification is going to be an asset. Unearned revenue, this one's always a fun one that sometimes nice. So now we're on to unearned revenue. I'm not sure if that was your answer for unearned revenue or whether that was for accounts receivable, but I'm going to guess it was for accounts receivable. So what about unearned revenue? What is unearned revenue? Debit in an asset for unearned revenue? Anyone else have any other thoughts? Liabilities and credit. That is correct. Because unearned revenue is revenue that is frankly unearned, and we haven't provided a service yet. So we haven't earned that revenue, which kind of brings us back to one of the topics that someone wanted to talk about, which is revenue recognition. And the revenue recognition principle states that you cannot record revenue until it has been earned. So unearned revenue is a liability because you owe a service, and that's essentially what a liability is. It is a future economic sacrifice or obligation that you normally can't get out of because you've received cash. Many times, unearned revenue is, normally because you have received cash in advance of providing the service. So you owe them the service later on. Retained earnings. Retained earnings. We're halfway through. We can do this, guys. We can do this. Retained earnings. Those reinvested equity and credit. That is correct. So yes, the normal balance of retained earnings is a credit because it is an equity account, and its classification is an equity account. Equipment. This is an easy one. Easy, easy, easy one. Asset and debit. That is correct. Lee's is just killing it. Intangible assets. All right, I think people are getting tired of the classification game, so I'll try to work through it quickly. Intangible assets are a normal balance of a debit because they're an asset, and the classification is going to be an asset. Sales revenue, on the other hand, revenue, how does that affect equity? Well, revenue increases net income. And when net income increases, our retained earnings increases. And when our retained earnings increases, our equity increases. So it's going to have a credit normal balance because, revenue has a positive impact on equity. Classification, you might think it's equity. It isn't. It's a revenue account. Dividends, on the other hand. Dividends are going to be normal balance of a debit because you are withdrawing earnings from the company. And the classification, it's a reduction to an equity account, but it's also a temporary account. And we'll get to those in a bit because temporary accounts, there's something special that you do with them. Does anyone want to spoil it in chat? What do you do with temporary accounts? I guess we'll have to get there. Okay, so we have our I just had the extra slide of all the answers. But I mean, we just covered that, so that's fine. I want to pop into Excel because I've got this problem, and I think it's going to be a really good problem for all of you that, this is going to be a big component on many people's final exams because adjusting entries are fun, and teachers love throwing them on an exam. So let's go through these. So what we're doing here is we're going to be reporting some adjusting entries, and then we're going to be moving on to preparing a trial balance, and then an adjusted trial balance with the adjusting entries that we've completed, and then creating financial statements with them. Is everyone cool with doing this little example? Okay, so let's go through this example. How is the, are you able to see everything fairly easily. I don't want it to be too zoomed out. Okay, so let's run through this. The additional information, the first one, the equipment has an expected useful life of 12 years. And useful life is a really important bit because depreciation and amortization does not use, it's not necessarily the life of the asset, but the useful life. The useful life is what's important for us calculating our depreciation. However, the vehicle's expected useful life is 8 years. And I should have, yes, right here. On the right-hand side, you can see that the equipment has a debit balance of $108,000. And the vehicles has a debit balance of $98,000. So, how are we going to get these numbers? We're going to be using straight line depreciation. That's the first thing we're going to be doing. Straight line depreciation. And I'm just going to hide these. Oops, hide those for now, because I want to get to the adjusting entries first. So, solution. We're going to take that equipment. This is the trial balance. This is what's given to us. And the way we figure out how much our equipment and vehicle cost is by looking at the trial balance, because the trial balance has the balance of our equipment and our vehicles. So the equipment has a balance of $108,000, vehicles have a balance of $98,000. So what we're going to do is we're going to take both of those amounts and divide them by their respective useful lives. So for instance, equipment has a useful life of 12 years. So we know that we're going to be taking the 12 years multiplied by 12 months for every year, and we're going to have, I believe that's like 144 months, but it's also $9,000 a year. Now vehicles, on the other hand, are going to be $98,000 divided by the useful life of 8 years. So we're going to have depreciable straight line depreciation amounts of $9,000 a year for equipment and $12,250 a year for the vehicle depreciation. So we're basically treating this as if we haven't accrued any depreciation expense for the year. So our first adjusting entry is going to be accruing a depreciable expense amount for equipment of $9,000. And then we're also going to be debiting depreciable expense $12,250 for the year for the vehicle. So that's our first entry. Is everyone comfortable with straight line depreciation and how I got both of those figures? I wish I had like a little ready check so I could just be like, does this make sense? I might actually have that somewhere. How we feel about this? Susie, Jeff, Lise, hopefully I'm saying your name right. Okay, so I'm just going to take that as people understand straight line depreciation. So let's move on to the second adjusting entry, which is a physical count showed supplies of... Okay, Lee's asked a question. I'm just going to quickly answer that before we get to the next one. What if the useful life changed? Well, that's a good question. If the useful life changed, that would be a change in an estimate, and a change in an estimate is going to be a prospective change. So that is going to be recalculated, and we'll have to adjust the expense amount. So if it's an estimate, or if the useful life were to be much longer, then we would have to make a change which would reduce the expense. And if the useful life was too low, then we would have to make increase the amount of expense. But I think that's outside the scope of introductory financial accounting. That's normally in intermediate accounting. So you won't have to worry about that, hopefully. I'm pretty sure. I remember that when I did intro to financials, we didn't have to do like retroactive or prospective changes until intermediate one. Okay, so next one. A physical account showed supplies, or $1,500 of supplies on hand at August 31st, 2021. Okay, so we're at point in time, we know we have 1,500 of supplies. Let's go and cross-reference this with our trial balance amount. So the trial balance shows a debit balance of $23,400. What does that mean? Well, the $23,400 is the amounts that we had before, and now a physical count is showing that we have 1,500 supplies. So what that means is that we need to take that supply balance and we need to calculate the difference between 23,400 and the 1,500 balance we now have. So we're going to be taking the beginning balance. Let me just zoom up so you can really see it. Taking the beginning balance and then the ending balance, and then this is the amount of supplies used. So 21,900. So this is our adjusting entry, because remember, we're not looking to record an entry that is like recording supplies. We want to show the adjustment, the use of the supplies, and 21,900 of supplies are being used. So we're going to show that by expensing, and we're going to debit supplies expense 21,900, and we're going to credit supplies by 21,900. So that's just a way to accrue the supplies expense. Now let's go back here. August 31st, 2021. There was $2,500 of revenue received in advance and the related service have not been performed yet. What does that mean? What is that entry? If we haven't earned that revenue yet. Well, if we haven't earned that revenue yet, it's going to be considered unearned revenue, right? So it's like deferred unearned revenue. And we need to show that. So this amount is going to be, there was $2,500 of revenue received in advance and the related services have not been performed. So we need to look at our unearned revenue, which was $4,500. So at the beginning it was $4,500, and now we have $2,500 of unearned revenue. So we need to figure out the difference between the two to show how much revenue that we've earned. So it's implied in this additional information that the unearned revenue has been slightly earned. So the difference between 4,500 and the 2,500 is 2,000, and we're going to debit unearned revenue because we debit unearned revenue to show that we're decreasing the balance in that account. And then we're going to credit service revenue. And that is because we've earned the revenue, and the revenue recognition principle states that once performance is complete and collectability is reasonably assured, which, that's already been fulfilled from the fact that we have received cash, then we're all good. We've earned that revenue. So that's why we're using an adjusting entry to show that we've earned it. Next up, DBREL has an investment in bonds that it intends to hold to earn interest until the bonds mature in 10 years. The bonds have an interest rate of 4% and pay interest on March 1st and September 1st of each year. What are we going to do here? So, where are the bonds at? The debt investments are 18,000. Actually, I think I should be looking at the bonds. Is there a bonds payable account here? Should be debt investments. It's weird that they're classified in the current assets amount, but I won't worry about that. So we're going to take that amount. So let's go down here, and we're going to take the 4% interest rate. Remember that whenever they state an interest rate in the additional information, that's an annualized rate. So we're getting 4% a year on the amount of 18,000. So that's equal to $720 a year, and the amount is payable semi-annually, which means it's going to be $360 each, I believe. It's because, there's only 5 months in, so we're paying interest on March 1st and September 1st of each year. So in this case, we're looking at the last payment was made on March 30th. So we need to show the difference between March and September, which is April, May, June, July, August. And then we're at, September 1st is the same as August 31st. So that's going to be 5 months of interest that we've earned. So we're going to take the $720 that we've earned for the year, and then we're going to prorate it by 5 months out of the 12, and that's how we get our $300. So the $300 is going to be considered interest revenue, and we're going to debit interest receivable. How's everyone doing with that one? And for any of the preceding ones. Okay, I will continue. So, next one is accrued salaries payable August 31st, 2021 is $18.50. So it says right there that we need to accrue salaries of $18.50. So there's not much to do with that question altogether. You just need to accrue the salaries expense of $18.50, and then you accrue the salaries payable amount of $18.50. So that's just trying to show that we have incurred an expense of using our employees' time, and we owe them salary. Therefore, we have to record it. Next up is the interest on 5% note payable is payable at the end of each month. and $8,000 of the principal must be paid on December 31st each year. Interest payments are up to date as of August 31st, 2021. So this one's a little bit tricky because it's not an adjusting entry. It kind of throws you off. So this one is, we're actually reclassifying the amount as a long-term payable to the current portion of the principal that has to be repaid. So the $8,000, so let's see, the interest on the 5% note payable is up to date. However, you still need to account for a change in the presentation of notes payable from a non-current liability to a current. So in this case, all we're doing is we're converting the long-term portion to the current portion of notes payable. And it's not really an adjusting entry, because an adjusting entry is either a prepayment / deferral, or it's going to be an accrual. So, this one was just meant to throw students off. And then finally, the owner, David Burrell, invested $3,000 cash in the business on December 29th, 2020. This has been correctly recorded. So in this case, the transaction is going to look like debit cash of $3,000, and then credit capital of $3,000. But the thing is that it's already been recorded correctly. So there's no reason why we need to create an adjusting entry, and it doesn't require an adjusting entry. So this is another one that just is meant to throw students off. It has no transaction required. So now that we've finished our adjusting entries, this is the next part. We need to take a look at our trial balance, and we need to take all of our adjustments. As you can see here, we've got them all lined up one after another, and we just need to turn this into an adjusted trial balance. So the first one is going to be, let's go through each of these. So we're going to have depreciation expense on equipment. So the equipment depreciation is $9,000. I'm just trying to think how I should set this up. Okay. Yeah, I'll just kind of enter it as I go. And also I'll put the reference in here for each of the transactions. Okay, so we're doing the first one. So the first one, we don't have a depreciation expense here, right? At least I can't see it. Repairs expense, insurance expense, interest, rent, salary. So we don't have a depreciation expense. We can go ahead and create a depreciation expense account, because, if we don't have that account and we are depreciating the asset, we need to now report that account. So this is the first adjusting entry that we did. And what is the depreciation expense? Well, the depreciation expense is going to be $9,000. So we're going to take that $9,000, enter it in there. So that's the debit side of that first adjustment. Now we need to do the credit side. So what's the other side of it? Let's go back to our adjusting entry. So all we're doing is we're just carrying over these amounts. So we've got a credit to the contra asset account accumulated depreciation. So we're going to go to accumulated depreciation right here, equipment. That's our first transaction, and it's going to be for $9,000. So right here, it balances. We got a $9,000 debit and a $9,000 credit. And we're going to do the same thing for each of these adjusting entries. So we're going to take the depreciation expense now for the vehicle, which is $12,250, and we're going to transfer that over here as well. And we're going to treat this all as like one transaction. So I'm actually going to take the 9,000 and I'm going to add 12,250, and that way we have a depreciable expense of 21,250. And in the vehicles, I'm going to add, well, since that's our first adjusting entry as well, it's just the second part of our first adjusting entry, I'm going to now also add 12,250. So now we have on the left side 21,250, right side 21,250. So that first adjusting entry was posted correctly. Let's go ahead and move to the second one. So our supplies were used up, as you might recall. So we're going to take the second transaction and post it. So we're going to have supplies expense. Do we have a supplies expense account? We do not. So I'm going to create another area and supplies expense, and I'm going to reference it as the second adjusting entry. And we're going to take the supplies expense of 21,900, put it there. Just making sure that I don't have a supplies expense account. I don't think I do. If I do, please feel free to say it in chat. And then we're going to take the supplies amount and we're going to credit it by 21,900, since that was the second one, as you see. So we debited and then we credited it. So we're just carrying it over once again. Next one, we're looking at unearned revenue that is being earned. So this is the third one, and that's going to be earning $2,000 of unearned revenue. So let's go up here and unearned revenue. Where is unearned revenue? Do we have an unearned revenue account? Yes, we do. Okay. So this is the third adjusting transaction. And since we're earning the unearned revenue, we need to debit it. So we're debiting it by $2,000. And we need to show that we've earned revenue. So we're going to reference the third adjusting entry here for service revenue and credit service revenue for 2,000. And that's all we do for the third one. Next one is a bond investment where we've earned interest revenue for $300. And that amount is going to be transferred once again. So we're going to go to up here, debit interest receivable for, sorry, what was it? Was it 300? Yeah, 300. So interest receivable. Do we have an interest receivable account? We do not. Okay, we do not. So interest receivable is going to go here, and we're going to reference it as the fourth adjusting entry, and it's going to be for 300 since we're increasing the interest receivable asset account by 300. And our interest revenue, we're going to increase that by 300 as well. I think 5 might be no, 6 is the last one. Okay, so the fifth one is we're accruing salaries expense for $1,850. So we're paying our employees. So this is our fifth transaction. So let's look for salaries expense, and we're going to say $1,850 for a debit. And the we're going to credit salaries payable. Do we have a salaries payable? Don't think we do. Salaries payable. And it's referencing the fifth adjusting entry, and then we're going to say $1,850. We need the one-piece reviews. Not sure what that means. Can you Can you expand on that? No pale? So that's our 5th transaction, and now we're moving on to the last one, which is reclassifying a long-term note payable as a current portion of notes payable. So we're going to be debiting notes payable by 8,000. So this is our 6th entry, and we're going to debit it by 8,000. And we're going to credit the current portion of notes payable. And that is the 6th amount, yeah. Okay. So that should be that. Let me just quickly look through everything to make sure we're good. I'm not sure why I have one extra little highlighted area here. Maybe it's because when I was going through this, I made a interest revenue account separately. Depreciation expense. Okay, so yeah, we've essentially transferred over all the adjusting entries. And now, how are we going to figure out our adjusted trial balance? How are we going to prepare this? What do you guys think? While you guys chime in, I'm just going to grab a glass of water. What are we gonna do? What are we gonna do here? How are we going to create our adjusted trial balance? Well, all we're gonna do is we're gonna take our trial balance from before, and we're going to include our adjusting entries. And that way we'll update it, and then it'll be an adjusted trial balance. So the first one, cash, 13,870 was from our trial balance. We have no adjusting entries. So this is just going to be 13,870. Did I say 13,900? My bad if I did. It's kind of confusing. Supplies, 23,400 was on our trial balance. And then we credited it for 21,900. So let's go ahead and create one of these little guys, a little T account. So our supplies had a debit balance of 23,400, and then we had this transaction which adjusted by 21,900. So 21,900 is the credit. The ending balance is going to be the 23,400 minus 21,900, and that's going to be a final debit balance of 1,500. So that's what we're going to have as our supplies amount. Interest receivable, we didn't have any amount on our trial balance statement, and we adjusted it by 300. So the final balance is just going to be 300. Remember, we're just adding all these up. There is no adjusted entry for debt investments, so this is going to be 18,000. Equipment didn't change, or at least the equipment account didn't change. And does anyone know why the equipment account doesn't change if we depreciate it? Why do we have this contra asset account accumulated depreciation? Why do we have it? Because we could just credit equipment and decrease the balance of that, why do we have this separate contra asset account? Well, we have this separate contra asset account because we need to segregate them, number one, because the cost principle says that when we record assets, they should be recorded at cost. Second, to comply with the matching principle, we need to be doing our best job to match expenses with the revenues earned by incurring those expenses. So when we made this expense entry down here, we're going to, the reason why we needed a credit account to offset that amount. So we credited the contra asset account, and the contra asset account gives us a really illustrative idea of how much depreciation that we've accumulated over time. So if we just credited the equipment account directly, we wouldn't have a good understanding of knowing how much total depreciation that has occurred. So let's move on. Accumulated depreciation, 38,250 plus 9,000. So we're going to add the two, since they're both credits, 47,250. Now vehicles are going to be 98,000 since we didn't have any adjusting entry. Next, accumulated depreciation has a credit of 42,875, and then we adjusted it by 12,250. So we're just going to add those two. And accounts payable is going to be 7,115. We didn't have any adjustments, so those are just going to be added together. Unearned revenue, we're going to take the 4,500 credit balance, and this is another good one where I can just quickly show you. When you're on your exam, you should be creating T accounts, because the T accounts help you figure out what the ending balance is and making sure that you're not messing up with debits and credits. So we're having the unearned revenue, and that's going to be an amount of 4,500 as a debit, and the credit is going to be it's the exact opposite. 4,500 is the credit and 2,000 is the debit, which means that our ending balance is going to be 2,500. So an ending balance of 2,500. So just make sure that we're doing this all right. 2,500. Perfect. Okay, next up, notes payable. 48,000 credit, 8,000 debit. So we need to net the two, and we're going to take 48,000 and subtract 8,000 because this is a debit. So we're taking a credit and netting the two. So a $40,000 balance in that account. You can start to see right now our adjusted trial balance isn't adding up, but hopefully by the end it does. So next one, salaries payable. We didn't have anything on the trial balance, so we don't have to worry about that. We just need to take the adjusted amount. Same thing as the current portion of notes payable, which is going to be 8,000. The capital amount is 68,175, and we had no adjustments to that, so same thing, just going to keep that the same. Same thing with the dividends because we have no adjusting entries. Service revenue, we're going to have 180,115, add it to the 2,000, and we have that total amount. Add the 360 in interest revenue to the 300, we'll have 660. Repairs expense, there was no adjustment, so we're just carrying over that amount. Insurance expense, no adjustment, just carrying over that amount. Interest expense, no adjustment, same thing. Rent, same thing. And then salaries expense on this side, we do have an adjustment, so we're going to add 40,500 plus the 1850, and that's going to give us 42,350. Supplies expense is a debit of 21,900. And is this going to balance? Well, we don't have a beginning amount in the trial balance, so we're just taking the adjustment and adding it. 412,790. It balances. Hallelujah! I'm really glad it balances because I didn't want to troubleshoot that. So we're all good now. And now you can see that I've actually filled out the rest to show how all of this gets carried over to the respective income statement and the owner's equity statement, which is, just another name for your retained earnings statement, and then your balance sheet. So let's just quickly go over how we prepared these. So this is our income statement. Let's, use a different color for this one, since that way we can differentiate between them. Okay, so income statement. The way we prepared this is by taking all of the revenue accounts, all the expense accounts. So we took all of them from the adjusted trial balance. And remember that the trial balance and the adjusted trial balance lists the accounts from assets to liabilities to equity and then revenue expenses. So we just need to look at the end to formulate our income statement. So service revenue, as you can see right here, 182,115. So we carried it over there. You can see where the cells are referencing one another. Interest revenue, 660, referencing that one. And then our total revenue is just the sum of those two accounts. Depreciation expense. I guess when I originally did this, I put depreciation expense there, but this time I actually added it at the very end, so I'm just going to reference a different cell, which is the depreciation expense. Excuse me, there. 21,250. Interest expense is going to be 25,355. Insurance expense, we're going to reference right there. Rent expense, we're going to reference the rent expense amount right there. Repairs expense, we're going to reference the repairs expense on the adjusted trial balance, so that amount. And then we're going to take salaries expense. This becomes a very mundane task of going down all of them, but it's necessary. So salaries expense, and then supplies expense is our final one. And that should be everything. I think I've captured every expense account: depreciation, interest, rent, salaries, repairs, supplies. Okay, so that's all good. That's our income statement, and our net income figure is $42,055. And you can see how they're interconnected, the financial statements, because this net income figure is transferred over to our owner's equity statement. So we're going to take the income and we're going to add it there. And that way, our beginning balance in capital was 68,175, and it didn't change because we didn't have any adjustment. So we're going to take that capital, which is also, our retained earnings amount. We're going to add net income because retained earnings are just all your earnings that have been accumulated, less drawings because those are, another word for them are dividends. And the dividends are redistributing that income and not retaining it in the company, so paying it out to owners. And the final retained earnings or capital ending balance is going to just be the retained earnings beginning balance, add the net income, subtract dividends, and you have $77,830. So that is the owner's equity statement or the retained earnings statement. And then how does this one connect with the balance sheet? Well, the balance sheet uses the ending balance in the retained earnings account. So the $77,830 is going to be it's going to appear there. And then we're going to list all of our permanent, and then we're going to list all of our assets, liabilities, and equity. So let's just double check that we have all of these reported correctly. So I just want to reference each of them. 13,870 for cash. Supplies is 1,500. Yeah, that's correct. Interest receivable. Is accounting that hard? I mean, intro accounting, I feel like it has a very, it can be a steep learning curve if you didn't take it in high school. But if you understand the fundamentals, everything is derived from those fundamentals. So if you understand, how debits and credits work, how all the accounts are interrelated, it's doable because there's no complex math included or used in accounting. Everything is just addition, subtraction, multiplication, division. A lot is, I tend to think of accountants more as lawyers because a lot of what accountants do are, reading through notes and providing note disclosures in the financial statements. So it's not as numbers based as you might think, besides the bookkeeping aspect, which is very fun, as you can tell. So interest receivable is 300, and that's the amount right there. And our total current assets are 15,670. So we're just taking the sum of those. Just making sure that I don't have any other current assets. I have debt investments, but I think those are long-term, yeah. So that references the 18,000. Debt, that's the equipment, yeah. Equipment is recorded at cost of 108,000. The accumulated depreciation on equipment is 47,250. Is that correct? Yeah, 47,250. W8, just making sure that it's referencing the right cell. Vehicles, 98,000, which is the cost, as you can see right here. And then we've got the accumulated depreciation amount, 55,125. That gives us a net of 42,875, and those are our total assets. We're taking our total current assets, add our long-term debt investments, the net book value of our equipment, and the net book value of our vehicles. And now we'll have total liabilities and equity. 52, just want to... Okay, so liabilities, now we're just transferring over the liability amounts. So accounts payable, what is the accounts payable? The accounts payable is 7,115. So let's actually reference that. I don't know why I didn't have that referenced, but we'll add it now. And then our unearned revenue is 2,500, you can see that unearned revenue, 2,500. And then the current portion of notes payable, once again referenced. Salaries payable, that's referenced as well. And then we're just, summing all of our current liabilities. Then we have our non-current liabilities, which are the long-term portion of our debt. And to get our total liabilities, we're just adding our current and our non-current liabilities. And then our capital is our total equity, which you can see is right here, 68,175. Why is this 77,830? Oh yes, because that's our ending balance for capital. Because so this was our capital account balance before we added our net income. Because remember, the balance sheet, the one account that it doesn't have that doesn't have an updated amount is the retained earnings balance, because you just finished the retained earnings statement right before. So, I should just change this to retained earnings statement, because I feel like it's confusing, or it might be confusing people saying owner's equity. So we took the ending balance in our retained earnings and added it there. So you can see it referenced that. And now our total liabilities and equity are 137,295. And a quick reconciliation check is take our total liabilities and equity, subtract it by the total assets, and there is no difference, which means that our assets equal our liabilities plus equity, and that's exactly what we're trying to do. We're trying to get those to balance. So for this last bit, I want to go through closing entries. So I want to do this one interactively, because I think closing entries can sometimes be a little bit tricky. So let's go ahead and do that together. So the service revenue account, we need to close that amount. Actually, I'm going to ask a question in the chat. Why do we have a closing? Why do we prepare closing entries? Why do we prepare closing entries? What is the point of closing entries? Let's go to our PowerPoint slides. I actually don't have one for closing entries. Not sure why I don't. Exactly, Brian. So all of these, all of the accounts, or not all of the accounts, but revenues, expenses, and dividends, they are all temporary accounts, which means the balances get reduced to zero for the next fiscal year, because it would be incredibly difficult for the income statement to do what it wants to do, which is show you the performance of the company for the year, if you had income from last year and the year before. You need to have a new balance at the beginning of the year to know how well you've performed for that fiscal year. So, since this example has all of the actually, no, I'm just going to continue with this one. I think that makes more sense. So what we're going to do is we're going to close the accounts, and by closing the accounts, we need to adjust them by whatever the opposite to their normal balance is. So for instance, the revenue account has a normal balance of a credit, therefore we need to debit all of the revenue accounts to decrease all of their balances. So the service revenue account has a balance of $182,115. Got some little Excel numbers because our cells are not. Okay, and then we're going to take the interest revenue amounts, and both of those revenue amounts are going to be closed to income summary. And income summary is a temporary summary of our income, because when we close the expenses and the revenue, the net of those two are going to be closed to income summary, and that's either going to be a net income or a net loss. So take the 182,000 plus the 660, and we're going to transfer all of the revenue over to income summary. Next up, we're going to close all of the expense accounts. So depreciation expense is the first one. Let's take 21,250. Next one is interest expense, 2535. Insurance expense, 8550. Rent expense, 18,900. Repairs expense, 25,235. Salaries expense, 42,350. And supplies expense, which is going to be 21,900. And the sum of all these are all the expenses that are going to be transferred from their expense accounts and closing them out to income summary. So let's take the sum of those, 140,720. So right now, what should be going through your head is that we have an amount of 182,775 of revenues that have been closed to income, and we have 140,720 of expenses closed to income. So we're going to have a net profit of $42,055. So that's going to be the net income. And you could also, just do this as equals the amount transferred to income summary, subtract the expenses, and you get the same amount. And we're transferring that to capital because remember, we're retaining all of this income earned for the year and moving it from the temporary account, income summary, to the permanent account, retained earnings, because retained earnings is on your balance sheet permanently. It's always going to be there. It's going to show the accumulated income less any dividends that your company has earned. And then we're going to transfer that entire amount, 42,055. And then do we have some dividends? Do we have dividends? I think we do. Dividends of 32,400. So 32,400. Oops, I want to add a little. Oops, other way. Oh my god. Okay, so we're going to transfer the dividends to income summary, and that's going to be taking away some of the retained earnings and distributing that to owners. So those were the three temporary accounts that we had to close. 4 if you consider income summary a temporary account, which you probably should. And that way we've closed all of the temporary accounts. We finished our financial statements for the year. And that's the end of the accounting cycle and the end of our question. So let me know if you have any questions about everything we went through. Does this kind of make sense? If you have any questions, feel free to shout them out in chat. How has everyone been finding studying through coronavirus? A little bit challenging? I know that some students who don't have as much ability to handle the lack of structure of studying on their own can find it difficult to do so in kind of the environment we're in right now. Luckily, I'm okay with not having too much structure, so I've always kind of been good with that. But if you're one of those people who needs to be in class or kind of at school studying, I can definitely see why this would be a hard time for you guys. If there's anything else that you guys want to cover, I'm willing to go through it. I was looking to wrap this up around like 8:30, but I mean, we have covered the accounting cycle. I'm not sure if Jeff is still here, but I know he wanted to discuss things about the revenue recognition principle, so I might be doing that. If he's still here. Just going to grab a drink. I'm gonna write that here. Feel free to post any questions in chat while I pour myself a drink. A drink. I'll come back and answer them in 1 to 2 minutes. Alright, so I'm back. So, I did say I was gonna stay here until 8:30, but I have finished the practice question that I did want to go over. So I'll just chill here, go over some Yahoo Finance stuff since I haven't looked at the market today. I'll be here till 8:30. Feel free to ask any questions in the chat. Oh my god, Shopify. Oh, tech bubble. Tech bubble. This is wild. I'm not sure if anyone has been following the market, but strange things lately. Very strange things. The amount of stimulus money coming in has kind of shot the NASDAQ into a tech bubble. It's wild. Actually, I'll do a little bit of, can I? There, that way I don't have to keep repeating myself and I can just let you guys see that. Feel free to ask any questions. What stocks do I own? That is a secret. What stocks do you own? What do you like, Susie? Are you leaning more towards accounting or finance? I mean, banks are always a very, very good investment. I think if you look at, if you have access to like a Bloomberg terminal, which is pretty hard to get, you'll see that the annualized return of dividends reinvested from the big four banks is about 12 to 13% a year. So if you have an investing horizon of about 20 years, Canadian banks, easiest money in the biz. That is not investment advice. That is just me providing my opinion on Canadian banks, which are exceptionally good at returning cash to their investors. US banks, they can sometimes be hit or miss. It really depends which ones you look at. JP Morgan, Wells Fargo. I don't follow too much of the US banking system. I'm more of like a macroeconomic investor. I like to follow different markets. In the US, I like just watching kind of like the SPY, the QQQ. In big indexes, they have a lot of liquidity, so you're able to get in and out a lot quicker than almost anything. They're great for options. Yeah. It is wild, though. The amount of money that the US Federal Reserve has added to their balance sheet in the last 2-3 weeks April 16th. Right now they've got $6.3 trillion on their balance sheets. Let's see before coronavirus, March 19th, 4.6 trillion. So that's, what is that? 1.7? 1.6? 1.7? 1.7. 1.7 trillion added to the Federal Reserve balance sheet. That's mind-blowing. Considering that after the 2008 Great Financial Crisis, it took 6 years for them to taper the Federal Reserve balance sheet by 500 billion. And they just recently added 1.3 trillion in the last 5 weeks. And that's why markets are doing this. Like, look at the last month. Whew. 168 to 215. Whew. Oof. Any questions you guys might have, feel free to post them. I'll be here till 8:30. That is 6 minutes from now. After that, grabbing some pizza, relaxing. And hanging out with Kyla. That's what she just said. That is my partner. Is it better to buy an ETF tech or stock like Apple? It completely depends on your risk tolerance. So, I mean, if you want to be less diversified, then Apple, definitely. If you want to be more diversified and less in for a shock, for instance, if Apple were to have some cataclysmic event and I don't know, if China just completely went under and their manufacturing sector went under, then yeah, it could be a higher risk than buying the entire tech ETF, the QQQ. I mean, Apple's a titan. They're their own country, essentially. I think they're worth like 1.36 trillion. 1.3 trillion. Yeah. Large company. The biggest reason they were able to jump from where they were in early 2000, like 16, 17, not many people know this, but not just because their products are good, which they are, and also their branding is good, but the changes in the tax laws in the US allowed them to repatriate a lot of foreign cash back to the US at a much lower rate because Trump lowered the corporate tax rate. So they were able to repatriate all that cash, which was in foreign jurisdictions, and able to reinvest that into their company. So, I mean, I'm not based in the US, so I am not as familiar with corporate tax rates, but even a 5% decrease in a corporate tax rate when you're repatriating like $50 billion is a lot. Your AAT level 3. I'm not familiar with that. What is that? Actually, I've got Google. Are you based in the UK? Looks like accounting diploma for entry-level accounting positions. I don't think it would be too advanced. I mean, if it is, you just need to go back to some of the earlier lessons, and then, gain the expertise and the competency to do those lessons. But most of my stuff that I have on my YouTube account is fairly introductory, so you should be okay and able to handle that. I'm going to be posting some new content soon, so I'll be having more intermediate and advanced accounting problems, things like consolidations, things that are fun, and accounting gets really fun. When am I going to do my CPA exam? Soon. Soon. No problem, Queen Bee. Yeah, my lessons start from just basic what is financial accounting, so you should be good to work your way through it. I also have a very a crash course that provides quiz questions, so if you want to go on our Facebook, you can sometimes see free codes that are dropped in there that give you access to the course and everything. It just includes all the private videos. Some of them are private. All right, the time is now 8:30. Thanks for being with me tonight. I hope you guys got something out of this with regards to our adjusting entry financial statement accounting problem. I'm going to go enjoy the rest of my Friday. I hope you guys do as well. Stay safe, wash your hands, and I might have another session coming up for cost accounting. So just stay tuned and watch my Facebook. If you haven't, subscribe, and thanks for watching, guys.